Right, let's jump straight into Aptus Value Housing Finance India Limited. This company, well, it's really captivated the market. We're talking a substantial market cap, rupees 16,513 crore. But the immediate headline is that the stock's corrected, what, about 8% in the past month? And that's after trading at quite a premium.
Exactly. And that correction, when you put it together with their strong underlying fundamentals, that really sets up the central tension we need to analyze here.
Okay, let's unpack this. With growth looking pretty consistent and margins apparently set to improve, the big question for you, the listener, is this. Does this recent dip make Aptus an immediate opportunity? Or, should you hold off and just watch from the sidelines for now?
Well, to decide that, you really have to first understand their very specific niche. Housing finance, sure, it's central to India's economic story, we all know that. But Aptus, they actively avoid the crowded metro space. Their entire strategy is built around towns and, well, the rural heartland, specifically Tier 3, Tier 4, and Tier 5 regions. That's where the real growth momentum is.
So that concentration is their competitive edge then, serving that large, often underserved population of self-employed customers. And looking at their loan book confirms this focus, right? We see, 78% concentration in LIG, the low-income group, and a significant chunk, 26%, are new-to-credit customers. Doesn't that risk profile make their operations inherently, more complex?
It does. It absolutely does. But that specialized risk profile is precisely why they command strong pricing power and therefore higher margins. They manage this risk on an average ticket size for a home loan of about rupees 9.4 lakh. And a business loan is only slightly less, around rupees 9.1 lakh. So these are essentially microloans enabling microenterprises.
And they stabilize that risk with a pretty smart hybrid business model. You mentioned business loans, about 33% of their AUM, their assets under management, come from those small business loans, and also quasi-home loans, like loans against property, not just pure home lending.
And critically, their operational model sustains this unique approach. It's 100% in-house. They don't outsource underwriting or collections, which is key. And the efficiency is very much digital-led. Over 90% of their agreements, and get this, 94% of their collections are digital. Consistency is just paramount when you're dealing with this customer segment, and digitalization helps enforce that.
Okay, let's shift gears slightly. Let's talk about recent market action, because that's been particularly telling, hasn't it? We saw stable Q1 FY26 results, maintaining that consistent focus on profitability. But the big story, really, was the valuation reset that happened just before a major institutional move.
Yes, the stock did moderate after trading at a significant premium for quite a while. And that moderation, you could say, set the stage for the real test of investor confidence, which came via the Westbridge exit.
Right. Here's where it gets really interesting. Westbridge, a key promoter. They sold the entire remaining stake, 16.2%, in September 2025, just gone, through a block deal. Now, normally, when a large institutional backer completely bails like that, especially in one big trade, the market expectation is a sharp drop in price, right? Because of the massive supply hitting the market.
But what's fascinating here is the stock actually gained more than 4% on the day this happened. Think about that for a moment. The market saw this huge supply of shares hit the tape, yet new institutional buyers just snapped it up instantly, actually pushing the price up. It's like the ultimate validation, The company's underlying value is now sort of decoupled from its founding stakeholders, confirming strong future faith from the market.
Wait, hang on. If the confidence is so overwhelming, why did the stock correct 8% in the month leading up to this event? Was that initial correction just profit-taking after hitting those premium highs? Or were investors maybe nervous about the Westbridge exit that was clearly coming?
I think it looks more like, standard institutional rotation and some profit-taking after that premium run-up. But the swift absorption of the Westbridge block really confirms the fundamental confidence. The market wasn't really selling the company. They were maybe just adjusting the price point before that large supply was due to hit. Makes sense.
Okay, so if that confidence is high, what does the future growth trajectory look like then?
Well, we can connect the stable performance directly to their future outlook. The guided loan book growth is, frankly, aggressive. They're targeting the 28 to 29% range for FY26. And the ultimate goal: scaling their AUM up to a targeted rupees 25,000 crores by FY28-29. Now, this is obviously contingent on, let's be clear, flawless execution of their expansion plan.
That's significant scaling. They reached, 301 branch locations in Q1 FY26? How do they minimize execution risks while expanding so rapidly? That's the key question.
Their strategy is what they call contiguous expansion. It means they don't just jump haphazardly across the country. They incrementally build outward from existing strong operational bases. This approach tends to minimize overhead risk and allows their centralized digital underwriting model to maintain quality control across new locations. That's the plan anyway.
And we're already seeing some success in new territories, aren't we? Like their foray into Maharashtra and Odisha. The loan book there has already crossed rupees 67 crores, apparently. That's quite a powerful signal for their scalability beyond those initial southern strongholds.
We do have to mention the seasonality impact, though. It's real. Q1 disbursements were slower. You often see these slowdowns during, the high summer heat and also when school fee payments are due in April and May. But that seems temporary. The recovery looks clear. Average monthly disbursements in June and July jumped up to rupees 350 crores. That's up significantly from last year's monthly average, which was around rupees 300 crores. So a definite uptick.
Absolutely. Now let's talk money specifically, profitability and efficiency, because this is where Aptus, well, it truly distinguishes itself, doesn't it?
It really does. Their return on assets, ROA, was 7.9%, and return on equity, ROE, was 20.1%. And just to put that into context for you, these are usually considered best-in-class returns. It shows they're utilizing both their operational assets and shareholder capital exceptionally well.
And this high profitability is achieved through, well, stellar margin management.
Precisely. We're looking at a very healthy net income margin, or IN, of 13.4%. That high IM acts as a really crucial buffer against potential micro risks inherent in their customer base, the LIG and new-to-credit folks.
And they seem to maintain efficiency even during this rapid expansion phase. Their OPEX operating expenses to asset ratio is expected to stay impressively low, around 2.7%. That means they are keeping their running costs contained even while they are rapidly opening those new branches. That's not easy.
And funding costs are also becoming a bit of a tailwind for them now. Their recent credit rating upgrade plus overall improved liquidity in the banking system means they expect to lower incremental borrowing costs by about 0.25%. That improvement goes straight to the bottom line, essentially.
And this detail seems critical for understanding their financial independence. Since March 2024, all their fresh borrowings have been raised without needing support from HFC guarantees. Why does that matter so much to the average investor listening?
Well, historically, housing finance companies, especially smaller ones, sometimes needed external backing or guarantees to secure cheaper funding. Aptus no longer needs that external safety net. It really signifies that the banking system views them as an independent, high-quality, standalone credit risk. That is a massive sign of financial maturity and strength. It's a big tick.
Okay, now we have to address the elephant in the room, valuation. If the numbers are this good, Aptus inevitably trades at a premium, and it's a very large one.
It does. Their PE ratio is around 20.8, which is high, but the price-to-book PB ratio is perhaps the starker metric. It's sitting at 3.85 versus an industry average closer to maybe 1.88. So you are basically paying almost twice the book value compared to their peers for this stock.
That is a hefty price tag. The justification, as we've noted, is those industry-leading ROA and ROE numbers, the strong growth. However, paying a premium this large means the market has absolutely zero tolerance for missteps. Execution has to be flawless.
Which raises a really important question. What risks are sort of built into or maybe ignored by that high price? We need to encourage some critical thinking here because if they miss their growth targets or if they experience asset quality issues, well, that premium could evaporate instantly.
Let's detail the vulnerabilities then. First, geographic concentration. You mentioned the South earlier. 70% of AUM is still in the southern states.
That's a huge dependency, isn't it? If they face a sudden sort of coordinated regional economic shock, say an unexpected political change or maybe a regulatory shift specific to that region, 70% exposure could hit their entire book hard and fast. Big risk there.
Second, customer risk. We talked about this. Their focus on the self-employed and new to credit, well, it means their asset quality is inherently more sensitive to macro factors. If the broader economy slows down, that customer base often feels the pinch first, which puts immediate pressure on collections.
Third, execution risk. Can they truly maintain that centralized 100% in-house underwriting discipline while aggressively adding branches across new states? Rapid scaling fundamentally strains consistency, and consistency is precisely what allows them to maintain those high margins and manage risk effectively. It's a tension point.
And finally, supply risk. Okay, Westbridge is gone, that overhang is removed. But the market has to be aware that other major institutional investors could still decide to liquidate their large stakes down the road. That could potentially create future supply pressure on the stock price, couldn't it?
So what does this all mean when we put it together? We've seen, I think, 3 clear strengths emerge from this deep dive into their operations in recent news.
Okay. One, they've definitely established a strong moat in that semi-urban and rural housing finance space, and it's underpinned by that resilient hybrid loan model.
Two, they have clear cost tailwinds coming through the rating upgrade, improving banking liquidity, maybe even future rate cuts eventually helping borrowing costs.
And three, they have a proven track record of execution so far, delivering those consistently industry-leading returns.
The narrative is compelling. It really is. But you are absolutely paying a significant premium for this quality. It looks like potentially a tactical opportunity right now. You've got growth visibility, potential margin expansion, and improving investor sentiment all sort of lining up.
So the real question for you, the listener, boils down to this. Do you believe Aptus can sustain its industry-beating returns? And critically, can they scale up to that aggressive rupees 25,000 crore AUM target by FY28 without the execution faltering under the weight of that expansion? If you have that conviction, well, then maybe the current dip represents a buying window. If not, perhaps waiting to see how the execution actually plays out in those newer states is the wiser, more cautious approach. That was a truly detailed and insightful deep dive into their strategy, the numbers, and the recent events. Really helpful. Now, before you go, we must provide our mandatory disclaimer. We are not SEBI-registered financial advisors. This discussion is for informational purposes only. If you're considering making any investment decisions, please consult a certified financial advisor.